Hi, it's Robert. Today we are going to discuss the detailed audit procedures the auditor performs when auditing the revenue and collection cycle. This is the second installment of the audit of the revenue cycle. Recall that part 1 covers the risk assessment phase of this cycle. As always, in the practice of accountancy, we should remember to be professional, perform effectively and efficiently, follow standards, and document our work adequately and properly. Our discussion begins with the comparison of the audit procedures an auditor designs when the RMM is significant or high and compare that to the audit procedures he might design when the RMM is insignificant or low. Next, we will look at the four-area uniform response model that we will use when performing the audit of the revenue, expenditure, investing, and financing cycles. After that, we will then apply that four-area model with in the audit of revenue cycles, sales adjustments, and cash receipts transactions. And so we're off to discuss the first topic of the audit of the revenue collection cycle, part 2, in slide 3. Varying degrees of response to risks. Once the auditor has identified and assessed the risk of material misstatement, he may now determine the appropriate audit procedures to perform. Audit procedures must be proportionate to the assessed risk, with areas of high RMM receiving more audit attention and effort. Responding to identified risks typically involves developing an audit approach that contains substantive procedures, for example, test of details, and when appropriate, substantive analytical procedures, and test of controls when applicable. The sufficiency and appropriateness of selected procedures will vary to achieve the desired level of assurance for each relevant assertion. While audit firms may have standardized audit program for the revenue cycle, the auditor should customize it based on the assessed RMM. As shown on the slide, the auditor may design an audit program that consists of first performing limited tests of operating effectiveness of controls, task 1, then performing limited substantive analytical procedures, task 2, and finally performing substantive tests of details, task 3. If the RMM is high, the auditor will want to obtain a great deal of evidence directly from tests of details. On the other hand, if the RMM is low and the auditor believes that the client has implemented effective controls in the revenue cycle, the auditor can likely perform tests of controls, gain a high level of assurance from substantive analytical procedures, such as reasonableness of balance test, and then complete the substantive procedures by performing a limited test of details. Slide 4. Uniform response model. For classroom purposes, we'll be using a four-area uniform response model for the risk response portion of the audit of the revenue, expenditure, investing, and financing cycles. This model is as seen on the slide. Step A will focus primarily on the analysis of the business processes to obtain an understanding of the internal controls implemented over the transactions. In the case of this cycle, the sales transactions. So you may refer to the flowchart, which is the business process itself that we have discussed in the revenue cycle in our former subject, AIS. The flowcharts will assist the auditor in identifying controls or control points and the necessary control features related to each control point. Moreover, you might also recall that controls were also discussed after the flowchart discussion in AIS. Thus, we need not dwell too long on this task today. Sample questionnaires which form part of the audit working papers will also be shared for you to visualize and appreciate the process of the audit evidence gathering. In Task B, tests of control over the transactions, we will be discussing the audit program and procedures done in actual audit in detail. In Task C, we will look at the audit program used for testing the controls. This audit program, when carried out, will be the basis for the substantive tests that will be discussed in detail in Task D, substantive tests of the transactions, which are examples of substantive audit procedures carried out in actual audits. Slide 5. At this point, we shall now discuss the audit procedures, the test of controls, and substantive audit procedures in the audit of the revenue and collection cycle. First, we will discuss those related to the sales transactions, and then this will be followed by the sales adjustments transactions, and lastly, the cash receipts transactions. Slide 6. Step A, obtaining evidence about internal control, operating effectiveness. Once the auditor has obtained an understanding of the entity's revenue cycle business processes and the internal control that management has implemented over the transactions through the various methods including walkthroughs, scrutinizing the documentations, observation and inquiry, the auditor may now answer a questionnaire which will help him to identify and document the strengths and weaknesses of the internal control. A sample questionnaire may be found in my shared Google Drive. Slide 7. Step B. Tests of controls over sales and receivables. Specific assertions are identified corresponding to the general assertions indicated in the financial statements. The general and specific assertions for sales and receivables are listed on the slide. We will discuss them one by one in the following slides. Note that in relation to sales transactions, the general and specific assertions also apply to sales adjustment transactions. We will also discuss the typical controls that are implemented over the business processes and also look at example audit procedures describing how the auditor can test if the controls are operating effectively. Note that these are only typical examples of controls and audit procedures and thus they do not cover them extensively. Additionally, when the client is heavily invested in information systems, the controls and audit procedures will greatly differ from when manual controls are put in place. The audit of controls in an information system environment will be discussed in the future subject IS Audit. Slide 8. General assertion, existence or occurrence. Specific assertion, recorded sales are for shipment actually made to customers. The controls on this and the next slide will cover for the assertions mentioned. The first control is described as recording of sales is supported by customer orders, sales orders approved by the credit department and approved and executed shipping documents. To test this control over the assertions, the auditor examines approved customer order, sales order, shipping document, and copy of sales invoice for sample entries in the sales journal. The document should bear the required approval, such that of the credit manager's approval. The description, quantity of goods shipped, name, address, and other details regarding the transaction should be consistent. If not consistent, the document should also account for the inconsistency among the details. For example, if the goods shipped is not equal to that ordered, there should be explanations of the cost and the disposition signed by an appropriate approving authority. Slide 9. The second control is described as a clerk independent of accounts receivable prepares and mails monthly statements to customers for all trade accounts receivable and follows up on any complaints. To test this control, the auditor observes the actual processes, whether the claim clerk, who is independent of the accounts receivable bookkeeper, prepares and mails the monthly statements and follows up any complaints. The auditor can also examine files on complaints and other correspondences received for selected dates. Slide 10. General assertion completeness. Specific assertion, all sales transactions that occurred are recorded. The controls in this and the next two slides will cover for the assertions mentioned. The third control is described as pre-numbered shipping documents are accounted for to determine that a sales invoice is prepared for all shipments. To test this control, the auditor can observe the client performing the procedure or select a sample of shipping orders and examine the invoices that bills the sales. The presence of a sales invoice copy indicates that the shipment was billed. Slide 11. The fourth control is described as pre-numbered sales invoices are accounted for to determine that all sales are recorded. To test this control, the auditor can observe the clerk recording sales if he or she is accounting for the numerical sequence of invoices and determines why any missing invoices have not been processed. The auditor can also select a sample of sales invoice copies to trace into the sales journal. Slide 12. The fifth control is described as procedures to ensure timely recording of sales and proper cutoff are established. To test this control, the auditor should inquire how procedures are followed, observe the procedures being followed, and inspect report on the last shipment that the shipping clerk sends to the billing clerk. Proper cutoff also provides evidence about existence of transactions. Slide 13. General assertion, rights and obligations. Specific assertion, sales recorded represent only sales transactions. The control in only this slide will cover for the assertions mentioned. The sixth control is described as a clerk checks sales orders and sales invoices for terms to determine that transaction is a sale rather than a consignment. To test this control, the auditor should observe that the control is being performed accordingly. Slide 14. General assertion, valuation or allocation. Specific assertion, sales are correctly billed and recorded. The controls in this and the next three slides will cover for the assertions mentioned. The seventh control is described as for all goods shipped, goods are counted and descriptions and quantities are compared to sales order and shipping documents prior to shipping. To test this control, the auditor should observe that the control is being performed accordingly. He should also examine a sample of shipping orders for the signature on the shipping documents that indicate that the counting and comparison occurred. Slide 15. The eighth control is described as Credit approval prior to shipment reduces the likelihood of the account becoming uncollectible. To test this control, the auditor should examine a sample of sales order for credit approval prior to shipment. Slide 16. The ninth control is described as sales invoices are checked for proper pricing, mathematical accuracy, and terms. To test this control, the auditor should inquire about the updating and use of price lists. He should also examine a sample of invoice copies to determine that they contain a signature indicating that the price, mathematical accuracy, and terms have been checked. Slide 17. The 10th control is described as the accounts receivable subsidiary ledger is balanced to the general ledger control account regularly. Note that the absence of this control results in the possibility of careless record keeping and omission of postings of sales or payments. To test this control, the auditor should observe the procedure being performed. The auditor may also foot the account receivable subsidiary ledger and compare the total with the balance appearing in the general ledger control account. Slide 18. General assertion, presentation, and disclosure. Specific assertion, sales and accounts receivable are recorded to result in presentation and disclosure in the FS in accordance with PAS and PFRS. The control in only this slide will cover for the assertions mentioned. The 11th control is described as sales must be properly classified to generate accurate segment reporting. Entities may require a second person to independently review or check the account coding on invoices. To test this control, the auditor should examine the invoice copy if it contains the approval of account classifications used. In case that the accounts used are integrated into an AIS, the auditor should examine the documents that contain the authorization for the use and approval for the update of parameter table in the system. This slide ends our discussion of the test of controls. Slide 19. The test of controls, when performed, may reveal weaknesses in that are factors that increase the RMM due to fraud and errors. And some of these weaknesses may even contribute to a culture where fraud is easily committed. You may refer back to Part 1 for some of the fraud schemes that may be perpetrated due to weak controls. Specifically, some identified weaknesses in controls in the sales and receivables transactions as listed on the slide may result to possible errors or misstatement in the financial statement could lead to an environment where fraud is easy to perpetrate. The following slides list some errors and fraud that may result from weaknesses in the controls over sales and receivables transactions. Slide 20. The test of controls discussed in slides 8 to 18 may reveal the following weaknesses and possible errors. Weaknesses and possible errors. Number 1. Weakness, ineffective board of directors, audit committee or internal audit function, undue pressure to meet sales targets, top management action not conducive to ethical conduct. This could lead to the following frauds or errors. The recording of fictitious sales without receiving a customer order or shipping the goods. This could also lead to recording of unearned revenue as actual sales. Does intentional overshipment of goods to ramp up the sales account or intentionally holding the sales journal open to record next year's sales as having occurred in the current year? And yet another effect of this first weakness would be the possible recording of revenue when significant uncertainties exist. For example, recording sales when the customer is likely to return the goods. Also, it might lead to recording of revenue when significant services still must be performed by seller, as when recording franchise revenue when the franchises are sold, even though an obligation to perform significant services still exists. This weakness might also result to overestimation of the amount of revenue earned for example, by misstating the percentage of completion of several projects by a construction company using the percentage of completion method of revenue recognition. Slide 21. Another weakness, second, that could be uncovered is the aggressive attitude of management toward financial reporting. Incompetent chief accounting officer, incompetent personnel involved in the estimation or accounting process. These weaknesses might lead to recording revenue when significant uncertainties exist, such as when the customer's payment is contingent upon the customer receiving financing or selling the goods to another party, for example, in a consignment sale. Another result might be the overestimation of revenue earned, such as when overestimating the percentage of completion on projects by a construction company using the percentage of completion method of revenue recognition. Slide 22. Third weakness, described as ineffective cut-off procedures in the shipping department, might lead to the early or late recognition of revenue, for example, recording sales in the wrong period based on incorrect shipping information. And the fourth weakness, an ineffective billing process in which billing is not tied to shipping information, and ineffective controls for testing invoice or ineffective input validation checks and computer reconciliations to ensure the accuracy of databases. These two weaknesses could result to recording of unearned revenue. An example result of the former weakness is the recording of sales based on the receipt of orders from customers rather than the shipment of goods. And an example result of the latter is the inaccurate billing and recording of sales. Slide 23. The last weakness, inadequate accounting manual, incompetent accounting personnel, could lead to, again, recording unearned revenue, for example, recording cash that represent a liability from receipt of a customer deposit as revenue. Slide 24. Illustrative audit program for tests of controls for sales transactions. You will find a sample PDF document of an audit program in my Google Drive with the same title. Note that the audit procedures described in that document are those we have discussed in Task B, but they have been modified to enable the auditor to select a minimum number of samples for testing. When going over the sample audit program, it will be noted that 1. To test for the assertion of existence or occurrence, the auditor tests from the accounting records and trace back to underlying documents that indicate that the transaction occurred. Number 2, to test for the assertion of completeness, the auditor compares pre-numbered documents to entries in the accounting records. The auditor can also observe the presence of some controls rather than examine a sample of documents to obtain evidence about a control. Slide 25. Substantive tests of sales transactions. The following are the assertions indicated in the revenue cycle and the corresponding audit objective of the auditor when performing the specific relevant audit procedures in the following slides. Slide 26. Audit procedures that aim to substantiate the target assertions. The first audit procedure is an analytical procedure that can also apply to other objectives including completeness, valuation, and proper cutoff. Related to these first 5 audit procedures, for a sample of entries in the sales journal, compare sales invoice copy, customer order, and shipping document. To test the existence of sales, some auditors examine the sales invoice, the customer's order, the sales order bearing credit approval, and the shipping document for a sample of entries in the sales journal. If an entity has a procedure to accumulate these documents before recording a sale or recording sales in a batch process, their accumulation is an indication that the control was performed. Other procedures may include A. Trace from the entry, removing the goods from inventory to the perpetual inventory record. B. Examine the cash receipts in payment for the sale. And C. Confirm the existence of individual transactions with the customers. Slide 27. Related to audit procedure number 6. For a sample of shipping documents, trace sales invoice and entry into sales journal and accounts receivable subsidiary ledger. Perform cutoff tests. The auditor may examine the sales invoice and determine that an entry was made in the sales journal and the accounts receivable subsidiary ledger. When testing to determine that all transactions have been recorded, auditors start with a pre-numbered document such as a bill of lading or a delivery ticket and trace it into the journals and ledgers. For a sample of sales invoice, examine the customer order and shipping document to determine whether the transaction should have been recorded as a consignment rather than as a sale. To determine that the entry has a right to receivable arising from sales transactions recorded, the auditor examines a sample of sales transactions and be alert for indications of consigned shipments treated as sales. Auditors should also investigate the procedure from recording movements of merchandise among the various units of the company. Related to audit procedures numbers 7 to 9, for a sample of entries in the sales journal, A. Examine sales invoice, shipping documents, and customer order for consistency of descriptions and quantities. B. Examine sales order for credit approval, and C. Check prices and extensions. Foot sales journal and general ledger accounts. This audit procedure for verification of a sales transaction that has been selected for testing may begin with a comparison of the customer's purchase order, the client's sales order, and a duplicate copy of the sales invoice. The descriptions and quantities of items are compared on these 3 documents and traced to the duplicate copy of the related shipping document. The original sales invoice and the original shipping document are in the hands of the customer. The credit manager's signature denoting approval of the customer's credit should appear on the sales order. The extensions and footings on each invoice in the sample should be proved to be arithmetically correct. After proving the accuracy of selected individual invoices, the auditor next traces the invoices to the sales journal and to postings in the account subsidiary ledger. In addition, the date of each invoice should be compared with two other dates, the date of billing and the date of recording to the general ledger. Related to audit procedure number 10, for a sample of entries in the sales journal, verify the accuracy of account coding. Auditors may review entries in the sales journal and the supporting sales invoice to determine whether the sales invoice was coded correctly and whether it results in proper presentation and disclosure of the transactions in the financial statements. This marks the end of our discussion of audit procedures for the sales transactions. Slide 28. After the sales transactions, we shall now discuss the audit procedures related to the sales adjustments transactions. Adjustments to sales may include 1. Granting cash discounts, 2. Granting sales allowances or reduction in price, 3. Returns of merchandise, 4. Volume rebates, 5. Correction of billing errors, and 6. Uncollectible accounts. As mentioned, we shall follow the 4-part uniform presentation which include 1. Evaluation of internal control over sales adjustments transactions, 2. Tests of controls over sales adjustment transactions, 3. Illustrative audit program for sales adjustment transactions, test of controls, and lastly, 4. Substantive tests over sales returns and allowances. Slide 29. Step A. Obtaining evidence about internal control operating effectiveness. As with the sales transactions, the audit procedures related to test of controls starts with the understanding of the business processes and internal control over those processes. Once the auditor has obtained an understanding of the business processes and the internal control that management has implemented over the sales adjustments transactions through the various methods including walkthroughs, scrutinizing the documentation, observation, and inquiry, the auditor may now answer a questionnaire which will help him to identify and document the strengths and weaknesses of the internal control. A sample questionnaire may be found in my shared Google Drive. A concern about these transactions is that a transaction may be recorded to cover a material misappropriation of cash receipts. Auditors generally pay little attention to these adjustments unless they are a material amount or individual adjustments are large. Slide 30. Step B. Tests of controls over sales adjustments transactions. As was stated in the discussion in the audit procedures related to sales transactions, the general and specific audit assertions listed on the slide are the same with sales and thus are also applying to sales adjustments and uncollectible accounts. Specific assertions are identified corresponding to the general assertions indicated in the financial statements. The general and specific assertions for sales adjustments are listed on the slide. Slide 31. Auditors often audit cash discounts in connection with the test of cash receipts transactions and sales returns and allowances with sales. Oftentimes, auditors perform only substantive tests of account balances. For sales returns and allowances, the primary emphasis is normally on testing the existence of recorded transactions as a means of uncovering any diversion of cash from the collection of accounts receivable that has been covered up by a fictitious sales returns or allowances. Yet the completeness objective cannot be ignored. Uncorrected sales returns and allowances can be material and can be used by a company's management to overstate net income. Of course, the other objectives, rights and obligations, valuation, and proper classification should not be ignored. An important thing to remember is that the same methodology for audit of controls over sales transactions discussed in slides 8 to 18 should be applied to controls over sales returns and allowances. On the other hand, the methodology for the audit of controls over cash receipts will cover for cash discounts. Slide 32. Step B, tests of controls over uncollectible accounts. Existence of recorded write-offs is the most important transaction-related audit objective that the auditor should keep in mind in the verification of the write-off of individual uncollectible accounts. This is because of the possibility of the client covering up a defalcation by charging off accounts receivables that have been already collected. The major control for preventing this type of misstatement is proper authorization of the write-off of uncollectible accounts by a designated level of management only after a thorough investigation of the reason the customer has not paid. Slide 33. The test of controls discussed in slides 8 to 18 and applied to sales adjustment transactions may reveal the following weaknesses and possible errors. Number one weakness is lack of numeric control over credit memoranda, which may lead to recording of fictitious transactions. Number two, unauthorized write-off of accounts receivable might lead to A, collectible accounts erroneously written off as uncollectible, or B, intentional write-off of accounts receivable as uncollectible to conceal misappropriation of customer payments. Slide 34. Weakness number three, unauthorized returns and allowances might lead to A, credit memos issued for authorized returns as well as for goods not actually returned, or B, intentional reduction of accounts receivable to conceal misappropriation of customer payments. Slide 35. Substantive tests of sales adjustment transactions. The audit objectives discussed in the substantive test of sales transactions discussed in slide 25 are essentially the same for processing credit memos for returns and allowances, with the following exceptions. 1. The first relates to materiality. If the amount of sales returns and allowances are so immaterial, which means the amount individually or in aggregate is below the class or scope materiality, they can be ignored in the audit altogether. Number two exception, this one relates to emphasis on objective. For sales returns and allowances, the primary emphasis is normally on testing the validity or occurrence of recorded transactions as a means of uncovering any diversion of cash from the collection of accounts receivable that has been covered by a fictitious sales returns or allowances. Of course, the auditor also gives due attention to the other objectives and should be able to arrive at suitable substantive tests of transactions which are essentially the same as for sales to verify amounts. Slide 36. The audit procedures that may be used for substantive tests of sales returns and allowances transactions include 1. Review the use and authorization of credit memoranda. All allowances to customers for returned or defective merchandise should be supported by serially numbered credit memoranda signed by an officer or responsible employee having no duties relating to handling cash or to the maintenance of accounts receivable subsidiary ledger. Number 2, review credits for returned merchandise if supported by receiving report on the return shipment. Number 3, verify prices, extensions, and footings and trace postings from the sales returns journal and other accounting record to the customer accounts in the subsidiary receivable ledger. Slide 37. We shall now discuss the audit procedures related to the third and last phase of the revenue cycle, the cash receipts transactions. Cash receipts transactions include number 1, receiving mail receipts, number 2, receiving over-the-counter receipts, number 3, aggregating total cash received, number 4, depositing cash in bank. Items 1 and 2 are not the only sources of cash receipts. Short and long-term borrowings, issuance of share capital, and sale of marketable securities, long-term investments, and other assets also bring in cash into the entity. However, the scope of this section is limited to cash receipts from sales transactions, which include cash sales and collections from trade customers on credit sales. Like we did with sales and sales adjustment transactions, we shall follow the 4-part uniform model of presentation. The nature of cash itself and the high volume of transactions flowing through the cash accounts make the accounts especially vulnerable to error or fraud. Organizations and auditors usually emphasize the quality of controls over the cash transactions. Slide 38. Step A. Obtaining evidence about internal control operating effectiveness. As with the sales transactions, the audit procedures related to test of controls starts with the understanding of the business processes and internal control over the cash receipts processes. Again, you may refer to the business process or flowchart discussed in detail in our AIS subject to gain an understanding of the process and controls. Once the auditor has obtained an understanding of the business processes and the internal control that management has implemented over the cash receipts transactions through the various methods, including walkthroughs, scrutinizing the documentations, observation and inquiry, the auditor may now answer a questionnaire which will help him to identify and document the strengths and weaknesses of the internal control. A sample questionnaire may be found in my shared Google Drive. Slide 39. Tests of controls over cash receipts. Specific assertions are identified corresponding to the general assertions indicated in the financial statements. The general and specific assertions for cash receipts are listed on the slide. We will discuss them one by one in the following slides. We will also discuss the typical controls that are implemented over the business processes and look at example audit procedures describing how the auditor can test if the controls are operating effectively. Note that these are only typical examples of controls and audit procedures, and thus they are not all-inclusive. Additionally, when the client is heavily invested in information systems, the controls and audit procedures will greatly differ from when manual controls are put in place. The audit of controls in an information system environment will be discussed in our future subject, IS Audit. As was stated, although entities' cash may come from many sources, this section focuses on collections of cash from customers only. Auditors are interested in the effect of controls on the financial statement assertions embodied in the cash accounts. In testing cash collections, auditors focus on the general and specific assertions for cash receipts listed on the slide. Slide 40. General assertion, existence, or occurrence. Specific assertion, recorded receipts represent actual collections of cash from customers. The control on this and the next 3 slides will cover for the assertions mentioned. The first control is described as a trustworthy employee prepared a pre-listing of cash receipts before further processing. To test this control over the assertion, the auditor observes whether a pre-listing is prepared and inquires of the preparer about the procedures he or she follows. Slide 41. The second control is described as a validated deposit slip is obtained for daily deposits and compared to the cash receipts summary. To test this control over the assertions, the auditor obtains copies of the validated deposit slips and compares them to the cash receipts summary. Slide 42. The third control is described as duties of handling cash receipts are segregated from posting to accounts receivable. A person performing both functions could misappropriate cash and conceal the shortage by making an entry directly to the customer's accounts. To test this control over the assertions, the auditor observes the separation of duties and inquires of client personnel about their responsibilities. Slide 43. The fourth control is described as a bank reconciliation is prepared monthly by a person not involved in handling cash, accounts receivable, or general ledger records. The reconciler should receive an open bank statement and maintain control over it until the reconciliation is completed. To test this control over the assertions, the auditor observes the bank reconciliation process and if the bank reconciliation have been prepared by an independent employee. Slide 44. General assertion, completeness. Specific assertion, all receipts are processed and recorded. The controls on this and the next 3 slides will cover for the assumption or the assertions mentioned. The fifth control is described as pre-listing and cash register procedures should be monitored. To test this control over the assertions, the auditor observes the monitoring of these procedures. Slide 45. The sixth control is described as checks should be restrictively endorsed as soon as they are received. This control prevents an unauthorized employee from gaining access to checks and cashing them, especially if the checks had been made paid to cash. To test this control over the assertions, the auditor observes the procedure being performed. Slide 46. The seventh control is described as a daily cash summary. Summary is prepared and reconciled to total of pre-listing and over-the-counter receipts. The summary total is compared to the total recorded in to cash receipts journal and the total on the validated deposit slips. This control ensures that all cash receipts are deposited and recorded. To test this control over the assertion, the auditor inquires of employees who carry out the procedure about the regularity and consistency of its performance. Slide 47. The eighth control is described as the cash receipts journal total is independently reconciled to the total posted to accounts receivable. This control ensures postings to accounts receivable. To test this control over the assertions, the auditor observes the procedure being performed and make inquiries of personnel performing the procedures. Slide 48. General assertion, rights, and obligations. Specific assertion, all cash receipts are deposited intact in the account of the entity. This is the only slide discussing the controls for the assertions mentioned. The ninth control is described as cash receipts are deposited intact daily in the company's bank account. This control reduces the likelihood of misappropriation of cash. To test this control over the assertions, the auditor observes the procedure being performed and compares the cash in the pre-listing with the validated deposit slip. Slide 49. General assertion, valuation or allocation. Specific assertion, debits to cash and credits to accounts receivable are valued at amounts received. This is the only slide discussing the controls for the assertions mentioned. The 10th control is described as cash receipts should be recorded at the amount indicated on the remittance advice. A remittance advice that has been processed by a third party serves as a strong evidence of the amount received from the customer. To test this control over the assertions, the auditor compares entries in the cash receipts journal to remittance advices. Slide 50. General assertion, presentation and disclosure. Specific assertion. Cash receipts transactions are recorded to result in presentation and disclosure in accordance with PAS and PFRS. This is the only slide discussing the control for the assertions mentioned. The 11th control is described as an accounting supervisor approves classifications made in journalizing. This control reduces the likelihood of payments being posted to the wrong accounts, resulting in credit balances in accounts receivable. To test this control over the assertions, the auditor examines the document where the signature of the supervisor indicating his approval is recorded. Slide 51. The test of controls discussed in the preceding slides may reveal the following weaknesses and possible errors or fraud. Number 1, weakness, lack of segregation of duties of cash handling and record keeping, bank accounts not reviewed or properly reconciled. This could possibly lead to fictitious cash receipts being recorded and processing errors intentionally or unintentionally are not discovered on a timely basis. Cash receipts are overstated on the books by transferring cash between accounts without appropriate recording of the transfer to cover up an embezzlement of cash. Weakness number 2, inadequate controls for reconciling cash register tapes and accounting records. Inadequate controls for reconciling bank accounts. This could lead to failure to record receipts from cash sales and unrecorded or recorded cash receipts are not deposited in the bank. Possible fraud schemes that may be perpetrated due to weak control include the cashier intentionally failing to ring up and record cash sales and embezzles cash instead, or a bookkeeper intentionally omits the recording of the receipts from one cash register for the day. Slide 52. Third weakness, sales are not recorded on cash register tapes. This could lead to credits to the wrong sales account. For example, sale of product A recorded as sale of product B. Number 4, weakness, lack of segregation of duties between personnel who have access to cash receipts and those who make entries into the accounts receivable records. This could lead to failure to record cash from collections of accounts receivable. Cash payments by customer on receivables may be embezzled by the personnel without recording collections from customers in the accounts receivable subsidiary ledger. Slide 53. Weakness number 5, inadequate reconciliation of subsidiary records of accounts receivable with the general ledger control account. This could lead to failure to uncover missing entries, which represent cash from collection of accounts receivable. For example, when bookkeeper accidentally or intentionally fails to record a payment on a receivable. Number 6 weakness, accounting manuals not used to assist in properly recording miscellaneous cash receipts. This could lead to miscellaneous cash receipts credited to incorrect accounts, for example, collection of rent income recorded as sale of merchandise. Slide 54. Ineffective Board of Directors, Audit Committee, or internal audit function, undue pressure to show improved financial position, top management, actuations not conducive to ethical conduct. This could lead to erroneous presentation of a more liquid position when in reality the entity might be cash-strapped and unable to support operations. This misleading position might be accomplished by keeping the cash receipts journal open to record next year's cash receipts as collections in the current year. Number 8 weakness, failure to list and deposit cash receipts on a timely basis. This leads to cutoff error, early or late recognition of cash receipts. That is, recording cash receipts based on erroneous information about the date of receipt. Slide 55. Substantive tests of cash receipts transactions. The following are the assertions indicated in the revenue cycle and the corresponding audit objectives of the auditor when performing the specific relevant audit procedures in the following slides. Slide 56. The audit procedures that may be used for substantive tests of cash receipts transactions include, but are not all-inclusive, the following. Number 1, for a sample of entries in cash receipts journal, trace to the pre-listing of cash receipts and to remittance advice. For a sample of entries, reconcile daily deposits to validated deposit slips. To test the credits to accounts receivable, an auditor can trace from the entry in the accounts receivable ledger to a cash receipts listing, to a deposit slip listing the payment, and to the customer's remittance advice. These documents provide evidence that a collection was made. Number 2, for a sample of days, verify that all cash receipts are recorded by reconciling daily listings or cash receipts and validated deposit slips to cash receipts journal. To test whether all cash receipts are recorded, the auditor compares the names and amounts included in the pre-listing for selected days with the entries in the cash receipts journal. Any discrepancies may suggest that lapping, a fraud scheme to embezzle cash, is occurring. To test for lapping, an auditor identifies a period of several consecutive days and trace the names and amounts from the pre-listing of cash receipts to the validated deposit slips to the cash receipts journal and to the postings in the accounts receivable subsidiary ledger. All dates, names, and amounts should be consistent. If the details are consistent, lapping did not occur during the time period examined. Slide 57. Number 3, procedure. For a sample of entries in cash receipts journal, examine remittance advice and verify that discount taken was appropriate. Put accounts receivable subsidiary ledger and reconcile to the general ledger account. To determine whether the credits to accounts receivable is proper, the auditor selects transaction from the cash receipts journal and recomputes the cash discounts allowed to customers who have made payments. Auditors may also verify its approval by reperforming the procedure that should have been performed when credit was approved. Number 4, review account coding for a sample of entries in the cash receipts journal. To determine that the transactions were coded correctly and will result in proper presentation and disclosure, the auditor compares entries in the cash receipts journal with the remittance advices. And there it is, part 2, the risk response phase of the revenue cycle. And that completes our discussion of the audit of this cycle. The next topic discussion presentation will be the audit of the expenditure cycle. Thank you and stay safe always.